Hi, Julian. I can't unmute.
Hello.
Hi,
there he
Julian.
is.
Sorry
All
about
right,
the
great.
technical issues.
No worries.
It's a pleasure to meet you.
Pleasure to meet you too.
Yeah, I was looking forward to talking to you. I've read some of your things. I'm not sure if you want to share your screen or not. If not, I could do it while we run down the markets. Your call.
We're not using cameras, gents.
No,
Okay.
we don't need the camera, but I was going to show, I'm not sure if you were going to bring any charts to talk about what you're, I know that you're a big dollar bear here, and I wanted to talk to you about that. So why don't I just go ahead and I'll share mine, and we could go like that and talk about different markets. So there you go, Julian. There's your website.
Okay, perfect.
Markets are noisy, and you may calm all the chaos. So you've been busy. Yeah, and I'd like your secret to making calm all the chaos. But why don't you tell us? I know you've gone through so much. You've been with a lot of different firms, and a little bit about your journey, and maybe what were important turning points for you during that process before
During
you
that multi-decade process, Dale. Yes,
I know. Me too.
Yeah, exactly. These grey hairs are one. Honestly,
silver, Julian. Let's start calling our
silver. Right. That's true. So I started as a young whippersnapper. Sort of actually before I even left university, I did a year working for Fibro, which was the commodity group, and then subsequently became Fibro Salomon, and then Salomon. And I started trading precious metals. That's why I got into trading precious metals. I traded the silver book for a while, and then I worked for Credit Suisse in Zurich, where I traded precious metal options for them in some pretty volatile times where the vol of silver hit. Actually, I sold an option at 112%. I remember that. And finished off my university degree. Ended up working for a name that some of the older members will remember, Drexel Burnham.
Oh, sure.
And then
Michael Milken. Did you ever meet Michael?
No, I was in the London office, and it was very demarcated, as I discovered from my girlfriend at the time, who was an auditor and explained that the company, this is like, I joined a year before it went bankrupt. She came to me one night and she said, you really need to leave. And I was like, why? And they said they're doing intercompany transfers between various divisions, lending money between various divisions of the firm, trying to shore up the balance sheet. It's completely illegal, and this thing is not going to last. So I had like a 3 months head up that Drexel was going down. But the one thing that Drexel did for me, I moved into F.A.C.E, and then I went from there to HSBC. And then from HSBC to Lehman Brothers, where I ended up running the sales team in London and New York for a while. And that's where I kind of cut my teeth.
You're jumping from blue blood firm to blue blood firm with nice upfront money deals, forgivable loans during that era.
I couldn't possibly comment on that, Dale. All I will say is that my best mate was my headhunter, and every 18 months to 2 years he seemed to successfully, for himself as well, make a lot of money by walking up my compensation package steadily.
See, we were in the business before the Bataan Death March of eliminating trading floors, etc. Ever spend any time on the trading floor?
Oh God! Well, all the time. It was all the time. No, not actually. Oh, on the floor. Yeah, for a while at Drexel, I did the cash to IMM ARB.
Oh, okay.
So I went. Yes, exactly. So I went to Chicago, and I had my brokers there. And actually, I was trading it the day that, God, this ain't dates me. Dollar mark was trading over 2.
Remember.
And then the US current account deficit number came out, and it was a blowout number. And the dollar started to collapse. And at one point, there was, I want to say, a 3 big figure divergence between futures and cash. 3 big figure.
I can make you feel younger, Julian. I was there. I was there on the CME floor when they were using a chalkboard for currency trading. The IMF had just opened. You don't remember chalk, do you? They actually did. They were trading currencies on a chalkboard.
I hear that from my daughter once in a while, and she's and she's trying to be sarcastic. So, Daddy, did they use smoke signals when you were trading the market back in the early days?
Well, you were able just to erase the trade off the blackboard. So, all right, let's get to, this is a very important juncture, and the debate is, and I know from reading your work that this was a big event in the dollar. You believe that this is only the beginning, that this whole rally in 2021 most likely is a bear market rally, and you're looking for a 30% drop in the dollar over the course of how long?
Well,
this year?
Here's the thing: the models that here's I think the fundamental thing that people don't understand. The US, by virtue of the fact that it is the reserve provider, is obliged, in inverted commas, to essentially run external current account deficits, either current account or capital account. And that is because unless they do, they can't provide reserves to the rest of the world. They have to, to oil the machinery, to oil the cogs of global trade, you need to provide reserves to a world that conducts its trade in that reserve currency. And the way you do it is typically run this current account deficit. And that's fine, right? And we've been doing it since, the post-war period, where the US has clearly been the reserve provider of choice. But, if you go back and you look at history will tell you that, one of the things that happens that causes the demise of the reserve currency is that you just slip into bad habits, right? I mean, basically, the world is subsidizing you because they're buying your assets and allowing you to import all these goods. You're sort of symbiotically providing them with the reserves. But there comes points in times where people go, geez, I've got an awful lot of these reserves. And we've been doing the same thing, right? We've been running an inordinate budget deficit. We've been running an inordinate trade deficit. And that was fine up until, I would say, 2008. And I say up until 2008, and really actually probably even before that. I mean, in the post-war period, there's sort of symbiotic relationship was pretty simple, because frequently or usually the reserve provider is also the most powerful military state. So, think of the UK up until the First World War, and then, it sort of wanes a bit.
What were their bad habits that caused them to lose reserve currency status to the dollar?
I mean, the deficit. I mean, we just ran up too many debts, paying for World War I and paying for World War II. Right? And they essentially, post World War I, had to effectively default because they rescheduled the war loans. And they'd had to borrow a lot of money and, sell off a lot of land and do all this sort of stuff. There was all this sort of land lease stuff that Churchill did during the Second World War, right? I mean, fighting wars is bloody expensive, right? Very, very expensive. And so, but it does go hand in hand with this. And usually, or certainly the US, I would say, up until the emergence of China sort of post its WTO membership entry, had a relatively balanced kind of relationship, because it was really being funded by the countries that it was providing the nuclear umbrella to. So South Korea, Japan, Germany. And so when you kind of got your allies as your funders, things are not that unstable, right? So then China comes in, it starts to displace some of these other people as the major exporters to the United States. We run up a deficit with them. That has created a natural instability, I think, and something that's structurally a little dangerous, and I do worry about occasionally. But perhaps not immediately, unless you really want to put your tinfoil hat on, Dale, and start thinking that the Chinese are going to, devalue the dollar by starting to sell treasuries and this sort of thing. Not an immediate problem, but there's another vulnerability, and that is the fact that certainly since 2008, the nature of the way that we have funded the deficit has changed dramatically. And I think that's a function of the steps that the Fed has taken from 2008 in terms of QE and they've done.
Julian, do you think that the Fed welcomes a weaker dollar because it makes it easier for them to go ahead with the taper and tightening without blowing up emerging market economies, and actually attracts more people to treasuries by letting the dollar go down and rates go
in
up?
part, but I think the problem in part, look, certainly Treasury seems to have changed its tune. Janet has talked about this. And, I think they recognize the vulnerability of the United States running such a huge current account deficit. We're back, if you look at the latest quarterly numbers, and they come out on a quarterly basis, if you annualize those, we're back up to the extremes of the deficit that we were in 06, 07. Right, so it's running at about $1 trillion a year now that we're relying on foreigners. But I think the real vulnerability comes in the nature of how foreigners are funding it. And the reason I say that, as I said, in the sort of pre-2000 days, and even with China, the deficit's funded by strong hands of foreign mercantilist central banks buying dollars as the dollar weakens, or they receive those dollars via their exports of their exporters, and cycling those back into treasuries, right? And those hands are referred to as sticky hands. They tend to not to shift those exposures very much. They'll hold them. They don't trade them. They're not really worried about the exchange rate, right? This is kind of the piggy bank that they have on a national basis. And that's all well and good. The problem is that since really 2008, we've seen, and the Fed's moved to essentially use QE and edit, and so it depress bond yields relatively as a result, yields have not been very attractive, right? And we now know that we're running extraordinarily negative real rates. And so it hasn't been a very sexy place for anyone to put their money into treasuries, right? And we've seen, the likes of the SMB in particular decide, screw it, we're not going to, why buy treasuries? We can go and buy Apple, right?
Yes.
We can go and buy Apple and stuff. And that's great in a way for them. It's not great for us because, we go from funding our overconsumption and our resultant deficit from a piece of paper that we can sell them, which is what a treasury is, to a share in a truly tangible asset and a piece of corporate America, right? So we are selling kind of the crown jewels, to use the expression.
Okay. Can you believe, Julian, that people were calling the FANG stocks a flight to quality and a safety trade, that they work? I can't make it up. This is what people were saying. That especially the crypto guys, when they went to cash, they didn't go to cash. They went to Amazon. They went to Microsoft. They went to Apple, and they parked their money thinking it was safe. And I don't know about your training, but something that goes up tenfold is usually
Correct.
not a risk-off asset.
Correct.
Me, right?
Correct. And I think this is the problem, Dale. I mean, I think, you know, I'm beginning to wonder whether the mechanics around this current account deficit, right? Remember, the current account deficit, I mean, you can get bouts of instability. If you're an emerging market and you run a huge current account deficit, there are times where you can get into trouble, right? Because we know that in emerging markets, what tends to happen, I mean, look at Brazil, you know, is a classic example. They run a big current account deficit, but it's all funded with super hot money, right? It tends to go into the like short-term depots and you know, 1 year instruments and 6 month instruments to sort of pick up carry and then all of a sudden something goes wrong and the money just evaporates. It doesn't trickle out, it goes, right? Goes.
Yes.
And the edifice doesn't just crumble, it collapses on you, right? I mean, just literally implodes, like one of those disaster movies where the high rise just crumbles in front of you, right? So I guess the US is lucky in the sense that the money is somewhat sticky, but there is absolutely no question that people are excessively overweight US equities on a relative basis. And if you look at, you know, US investors, they probably should run 65-35 US to overseas equities. I bet you that, and I've talked to friends of mine who who run big RIA, you know, retail businesses. They're saying that, you know, they can't get clients, and they haven't got any clients who are really in overseas. Maybe they've got 10%. Maybe they've got 10%. And I think that whole sort of metric is carried on globally. Everyone is overweight US stocks, and foreigners have I think, an extraordinarily dangerous dynamic, and that's that they've basically been playing, you know, twofers, right? They've been getting 2 for 1, which is what that expression means. So they've had a strong dollar, and rising outperforming US equities.
Yes. Okay. So
that creates an unstable dynamic, right? That creates a very unstable dynamic. And so when you look, and you just showed the chart of Apple, right? When you look at Apple or you look at Google, Alphabet, right? You see these very, very abrupt rises, right? Post-COVID. You know, if you take it back to sort of 2019, if you can.
We can.
You know,
2019.
Yeah. So here you've got a stock that sort of pre-COVID, you know, had been stable for quite a while, around 1,200.
Yes.
Right. You know, it's a great company. Don't get me wrong. Right. You never create. I've gone back and looked at all bubbles, Dale. Right. You know, going back as far as I can, and typically they're created in something with a spectacular narrative. Right, where there's a fundamental underlying story. About the only one that I can't make any sense of was the Dutch tulip bubble. I struggle with that one, but you know, a classic was the opening up of the Argentinian of Argentina via railways, which were funded by and large by British and European investors. And, you know, the idea was you were going to get Argentinian beef and you were going to export it to the rest of the world, and it's going to be super cheap. And indeed, it was transformative. I mean, if it hadn't been for what was referred to as Argentinian bully beef, we wouldn't have been able to slay millions of men in the First World War because we wouldn't have been able to feed them in the winter. And typically what happened is wars stopped in the winter and everyone went home, but not the First World War, because we could feed them. So to say that this wasn't transformative is wrong, but the point is the investors lost a shed load of money, right? And this is, when I look at this Google chart, you know, you break out on basically the back of the Fed's QE, right? They just drive this thing higher. It goes into the stocks where the narrative is the strongest, where these, you know, Cathie Wood's ARK is a classic example, right? A super long duration stock as yields get suppressed. and we create bubbles. And now, you've got this twofers trade on where you're Johnny Foreigner, you're overweight versus your benchmark US stocks. It's been an amazing trade. They crushed your domestic indexes.
Yeah, one of the best.
But you're unhedged.
Yeah.
And you're very, very long, very, very expensive US stocks. Right? Very, very expensive US stocks. And there is an instability there. Now, maybe it doesn't go yet, right? Maybe it doesn't go. Maybe the earnings are so good, right? Just note the slight tone of sarcasm there, because I think it's fully discounted, as we can see with the banks. Maybe the numbers are just so good that it isn't a problem. But what if it is a problem?
Microsoft.
Right.
One of the monsters. So what I'd like to know, Julian, is if you are bearish as dollar, and there has been outperformance by Europe and emerging markets the last 3 weeks to a couple of months, right? So it's just starting.
But it's not really kind of positive outperformance. It's US. I always refer to this, Dale, as which way does this thing end up? These divergences end up correcting. The nice way, the US kind of goes into a sideways funk for a while. The rest of the world catches up, and you have a gradual removal of foreign money from the US markets. Or the nasty way. The nasty way is everything goes down because the US equity market, I mean, arguably bubble in certain sectors bursts, right? And the NASDAQ goes down 40% and the Euro stocks only go down 20, right? The divergence collapses, but you still lose money.
Yeah. So on your dollar call, are there fiats you like against the dollar?
I think
what would they be?
Ultimately, you've got to be in the currencies that have funded the deficit. And predominantly, that's Europe. Okay.
So Euro, how about some of these commodity currencies like the Aussie, Julian?
It's a tough one because I think the problem is if you go, yes, in theory, right, a weak dollar should be good for commodities, but by and large, these countries produce non-precious commodities, right? So in other words, ones that are linked to industrial activity. Correct, sir. Right. So I'm not sure that that's where you want to be. I think this could be an environment, and as I said, we're not there yet, Dale. There's some clues that I'd be looking for to suggest that these flows are reversing.
Yes.
Okay.
Give us one.
Like
be looking for.
Yeah, I mean the relative price action in various time zones. So if I start to see the euro come under pressure, say in the US time zone as stocks are sold off because people are viewing the dollar as a safe haven, but then we walk in and we find during the European time zone, as say S&P futures come under pressure, that the euro isn't going down but is going up because it's Europeans selling their S&P futures and converting them back into euros. Okay. Then that would be a clue to me.
Okay. So that would be a market tell. So you pay attention to different time zone trading.
Correct.
To see. Okay. So if you don't have to pick fiat, the metals are trying, Julian.
Yeah, I mean, gold and silver to me. I think, I'd love it if we got silver
down to 19.
Yeah, exactly.
You and me are dreaming the same thing. So
yeah, I mean, if you've got a little bit, I don't think it's heavily owned, so I'm not sure that's going to happen, Dale. Yeah. But I would like a VAR event to get silver back down to that sort of, where is it?
How about this for a vol event?
1920 sort of level.
Yeah, I like that level. How about this for a vol event? Putin goes in. Are people going to buy the euro or buy the dollar? I mean, the
No, and
UK has.
that one, you'd get a big spike in the dollar, I think,
Okay,
because
so
that is
that's what we
truly
would
a
need.
geopolitical one. I think
Yeah.
then you'd see how it would pan out, and I think the other thing is you'd get these central banks kind of step back from the idea of removing accommodation. So that actually, I think, would continue the sort of bubble phase of the US, or the dominance of the US, where the Fed comes back in, you get a sell off, the Fed would come back in, everyone will go, what the hell does it mean for Microsoft, right? And the answer is nothing, from an earnings perspective. And then you sort of continue that. But the fundamental problem here is, Dale, that the Fed needs to now remove accommodation, not because of inflation. Look, we've got clearly inflation. We've been in that camp since March of 2020. We started to put our first inflation trades on. And we've been banging that drum for a long, long time. But now they need to remove accommodation because we've closed the bloody output gap, right? This is an economy where the nominal GDP output gap, which we didn't close after a decade post the GFC, right? 2019, we were sort of close to getting back to trend nominal GDP growth. This time we did it in less than 2 years, right? So we now have 3.9% unemployment, right? I'm told that the internal number within the FOMC is within this FOMC is 3.8 for full employment. So we're going to be there next month probably and well through it, right? They've got wage growth and they've got an economy which is growing at about 6%, which is double trend. Right? Double trend.
Well, let
me
ask you this.
They need to tighten to slow the economy.
Slow demand is all they can do.
Correct.
All right. So, you know what? Are higher rates going to take the price of beans and corn down and coffee down and things that grow out of the ground? Are you going to go on a diet because the Fed is raising rates?
And the answer, no. But I am cautious because I think these commodities are quite heavily owned now. And if we get a VAR event, and this is the problem with Bitcoin, right? I mean, I was chatting with Raul the other week, right? I mean, I do think that Bitcoin has been a beneficiary of this excess liquidity by the central banks. To my mind, there's no question of that. If the dollar goes, would it be a great, could it be a great trade? It could, but it is quite heavily institutionally owned now. Right. I mean, I think, this is chart. And I think if you look at those lows and highs around 38 to 40,000, it's not a bad place to try and have a stab at buying it. But do be conscious, this is owned by players who have positions in other assets.
Yeah,
and if they start
markets.
and if they start to sell off, Dale, we know what happens, right?
Yeah.
I've sat on enough
sell
trading
the kitchen sink if you need
to
raise
everything
cash.
gets sold, right? The guy, because the guy at the hedge fund gets a tap on the shoulder from the risk manager who says, cut your book by 30% because the vols are up.
Right. Well, Julian, I tell you, I really am glad I reached out to you, and I appreciate that you were open to coming to our little venue and sharing your views, having a giving spirit and sharing your views to our community here at ForexAnalytix. And would love to talk to you again as things progress. And it's going to be an interesting dollar call. I'll ping you if silver gets to $19. So
please.
Just in case you're like me looking the other way and
looking the other way. Yeah. Looking the other way. Exactly. And look, if any of your listeners want to sort of follow me, feel free to ping me or to follow me on Twitter. That's probably where I'm most active, at Julian MI2. You can see it up on the top there. And then you can
have a free newsletter here too.
We do have a new free newsletter. It's really good. It tends to sort of analyze a lot of the stuff that's going on from policymakers and some of the other developments we think are kind of interesting that are in the public domain. So it is curated and commentary. It is, it is done by the team, and we do put effort into it. It's not just a freebie piece of crap that some of these things are, that's designed just to get your email. We do put effort into it.
Really appreciate being able to meet you, Julian, talk to you. And after someone finishes an interview with me, and they survive, you become a trading warrior, brother. So
thank you very much indeed, sir.
All right. So really great way to cap off the week, Julian. I hope to be able to continue our conversation down the line together.
Thanks, Dale. Much appreciated, sir.
All right. So
cheers.
Cheers, Julian. So that's it, everyone. You could join the team in the Morning Edge and have a great week. Remember, most of all, don't just count your pips, count your blessings. And we laid it all on the court for you guys this week. Do your work over the weekend, and I'll see everyone Monday. Adios. And thanks again, Julian Brigden.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.